Right now, Archer Aviation is trading at $7.96, up just slightly, about 0.19% on the day. That's a tiny move, barely a flicker on the screen, and that's precisely what makes it so interesting. The expectation for a stock like Archer, a name synonymous with the flying taxi future, is constant, gut-wrenching volatility. People see the sleek midnight aircraft renders, they hear about the massive pre-order from United Airlines, and they assume the stock should be leaping 10% or dropping 8% every single day. The common belief is that this is a lottery ticket, a pure speculative play you buy on the Robinhood app, close your eyes, and hope for the best. But the reality, looking at this $7.96 price and the tight, low-volume channel it's carving, is something entirely different and far more complex. This isn't the wild, retail-driven hype of a few years ago. This is the quiet, agonizing tension of a show-me stock. The price isn't reflecting a dream anymore. It's reflecting a high-stakes, high-anxiety waiting game. The real battle for Archer is no longer about the idea of urban air mobility. The market has accepted the concept. The battle is now fought in the trenches of FAA certification timelines, battery density physics, and brutal, unyielding quarterly cash burn rates. What we're seeing today, this fractional 0.19% move, isn't boredom, it's a coiled spring, a market holding its collective breath, waiting for a definitive signal on whether this company is the next Tesla stock or the next aviation footnote. Let's break down the recent action. This $7.90 to $8 range has become a significant psychological level. We've seen heavy resistance just above $8, suggesting some larger stakeholders, perhaps early investors or funds managing Fidelity Wealth Management accounts, are trimming their positions, taking profits off the table. Conversely, a floor of support seems to be building in the mid-$7 range, where dip buyers, many executing trades through their SoFi Invest or Fidelity mobile app, see value. The volume today is relatively light. This is key. When a high beta stock like this goes quiet on volume, it tells you the fast capital, the day traders, are on the sidelines. The only people left in the game are the long-term holders and the institutional desks, the ones using sophisticated platforms like interactive brokers to slowly accumulate or distribute large blocks without moving the price. This stock, like all pre-revenue growth names, is a slave to the macroeconomic environment. We are in mid-November 2025, and the narrative is still about interest rates. A company like Archer, which has all of its potential earnings projected way out into the future, is exquisitely sensitive to the cost of capital. Every time the Federal Reserve hints that rates will stay high, the discounted cash flow model, which is one of the only ways to even attempt to value Archer, gets hit with a sledgehammer. The future value of its potential business is worth less in today's terms. This is a pressure that a mature, cash-rich company like Apple stock simply doesn't feel. It's even a different world from Nvidia stock, which, while growth-oriented, is generating enormous amounts of cash right now. Archer is spending, not earning. And this sector context is critical. The entire eVTL space, from Joby to eHang, often moves as a basket. A positive regulatory update for a competitor can lift Archer, and a setback for one can poison the well for all of them. This isn't like picking between different Fidelity ETFs that track the S&P 500. This is a binary, winner-take-most, high-stakes competition. Investors in this space are constantly trying to parse grainy test flight videos and dense regulatory filings to figure out who is actually 6 months ahead in the certification race. That race is the only thing that matters. So, if the daily trading is just this tense waiting game, what exactly is everyone waiting for? For anyone new to the story, Archer Aviation is building electric vertical takeoff and landing aircraft. The Midnight is their flagship, a 5-seat vehicle, pilot plus 4 passengers, designed for short cross-city hops, aiming to turn a 60-minute car ride in traffic into a 10-minute flight. The business model is twofold. Sell these aircraft to airlines and logistics partners like the landmark United deal, and potentially operate their own urban mobility networks. The expectation is that this is the future of transport. The reality is that this is one of the most difficult engineering and regulatory challenges ever attempted. The only metric that matters for ACHR right now is progress toward FAA type certification. This is a multi-year, multi-stage, incredibly expensive gauntlet. The company is currently in the implementation phase, but the real hurdle is for credit flight testing. Every press release, every quarterly call, every SEC filing is scrutinized by analysts not for revenue, there is none, but for coded language about this timeline. Did they slip a date by a month? Did they use the word progressing instead of on track? This is the kind of detailed work that separates successful self-investing from gambling. You can't just set up an intelligent portfolio and let it ride. This is active, hands-on online investment. This is also where the partnerships become so critical. The market expects the Stellantis, the automotive giant, partnership to solve ACHR's manufacturing problem. The reality is that building cars at scale and building certified aerospace vehicles are two profoundly different things. The certification standards for every single component are worlds apart. Stellantis provides immense value in supply chain management and mass production techniques, but the execution risk remains gigantic. We're all watching the progress on their high-volume manufacturing facility in Georgia. Is it on time? Is it on budget? A delay there is a delay in the entire business plan. And all of this, the R&D, the test flights, the factory, the lobbying, costs an astronomical amount of cash. Let's talk about the balance sheet. ACHR ended their last quarter with a healthy cash position, bolstered by previous capital raises and partner investments. But their quarterly burn rate, the speed at which they are spending that cash, is substantial. This $7.96 stock price is a clock. It's a race between their certification timeline and their cash on hand. If the FAA approval process gets delayed by 18 months, their current cash pile will not be enough. They will have to raise more capital. The market knows this, and in a high-rate environment, raising capital is painful. It means dilution. It means issuing new shares at a potentially lower price, which makes every existing share, including the ones you might be holding in your Fidelity or SoFi account, a smaller piece of the pie. This is the structural headwind. That's why you see any news of a new government grant or a non-dilutive financing deal send the stock soaring, and any rumor of a secondary offering sends it plummeting. The expectation is that the current funding is sufficient. The reality is that it's probably not if there are any significant delays. This is the central risk. So, how do we look at the future? The bull case is simple and intoxicating. The expectation is that certification is hard. The reality could be that ACHR's close, transparent work with the FAA, which has been praised, gives them a faster and more predictable path than skeptics believe. If ACHR is the first to get full type certification for a 5-seat, commercially viable eVTL, this $7.96 price will look like a historical joke. The United order and its follow-ons would be unlocked. New orders from other airlines and logistics firms would pour in. The stock wouldn't just double, it would be a 5x or 10x return. This is the dream that keeps this investment thesis alive. The bear case is just as real. The expectation is that they'll eventually get certified. The reality could be a single major setback in flight testing, or a new intractable problem with battery performance, or the FAA, under public or political pressure, could simply decide the entire concept of flying vehicles over dense urban areas is too high risk and bog them down in a decade of red tape. This is the brutal nature of online investing in pre-revenue deep tech companies. It's why you'll never see a pure-play, high-risk name like this dominate a Schwab Intelligent Portfolios build-out. It's just too volatile. It's a portfolio definer, for better or for worse. The timeline is everything. The company is publicly targeting commercial operations in the 2026-2027 window. That's coming up fast. I want to know what you think. Comment below. Do you believe ACHR will get full FAA certification for Midnight by the end of 2027? Yes or no? And tell me why. The specific catalysts to watch from here are 1. Any and all news about the 4-credit flight testing. This is the big one. 2. The quarterly cash burn rate and the cash remaining figure. 3. Any updates from the FAA, positive or negative, not just for ACHR, but for the entire sector. And 4. The build-out of that Covington factory. These are the real indicators, not the 0.19% noise we're seeing today. This isn't the kind of stock you trade on a whim using Robinhood crypto-style analysis. It's an individual brokerage decision that requires